for people like me who admit that, we know very little, to see that maybe home prices aren't going to go up forever. Maybe things are going to change. But people who just see trends going in one way forever, they'll set themselves up for failure. All right, so round 2, don't reinvent the wheel. This is probably the most important thing that I'm going to say today. A couple key ratios and where I got them. You got Ben Graham's price to book. He was basically a value investor. So the price of the company to the net asset value of the company, so assets minus total liabilities. He would look at that, and he would also look at price to cash. And he would invest in plays where those ratios look good. And then you have Warren Buffett, I believe. Warren Buffett was PE, price to earnings. And then you've also got Peter Lynch's price to earnings growth ratio, which is really the most important. If you can ever get this right with any accuracy, this is the most important ratio that there is, because a company should be priced at the sum of its future discounted cash flows to you as the investor. And then there's Ken Fisher's price to sales, which I believe was proven, or most proven to be it has the most relation or positive correlation with stock price. And people have been using price to earnings for a long time, so it's interesting to know that price to sales is actually more of a indicator of what stock price should be than price to earnings. All right, so then knockout is you use these for key ratios and you just start looking at companies. And I would recommend doing 100 in less than an hour going. And you look at them, and what it does is it builds a mental database of kind of what you're looking for. And you want to price to book, you want to minimize price to earnings, you want to minimize price to sales, you want to minimize price to cash, you want to minimize. I guess you want to minimize them all. But like I said, price to earnings growth is Peter Lynch's, and if you can get that right, especially looking forward, if you can get that below 0.1, you're going to make a killing. So here's what works, here's what doesn't work. All right, how the big money is made. So the big money is made by sorting through 10,000. Yeah, what's up?
So what are some values you want to shoot for, like a PE less than 10?
It really depends on the current market. What would you shoot for? And I'll tell you what I shoot for. PE less than 10? Right now I'm shooting for PE less than 4. And growth greater than 30%. Something like that. So I look for PE less than 4, growth greater than 30%, less than price to book, less than price of sales, and price to cash is a bonus for me. What's up?
Why do they teach you to stay within a certain boundary for PE, like companies that are valued more than 15 or less than 15 you should stay away from?
So you only want to buy companies that have a price to earnings ratio of 15?
No, I'm not saying that's what I want to do, but
yeah, generally companies that are in trouble will have really low PE ratios, and it's because they're in trouble and they're shrinking. What I'm trying to do, the growth is all future growth. What's happened in the past doesn't really matter, except for that it's an indicator for what's going to happen in the future. Generally, to be safe, financial advisors advise that you should be like everybody else and pick safe companies, because that way you won't lose your shirt. And I don't know, if I were to try to guess what they would do, they'd probably look for PEs between, 10 and 20. Depending on, there's this huge thing out there that's really ridiculous of growth versus value. And for some reason, people believe that they should be differentiated. I think that looking at them as two different investing strategies is just totally wrong. I think growth is a component of value. I think if you're discounting cash flows and there's a growth factor on those cash flows, it should be taken into account if you're pricing a company based on those future cash flows. But yeah, PE 10 to 20. I mean, they say that growth companies have a PE, you can buy them with PEs of 30 plus, and you've got Google and Apple and Baidu, which Baidu's overpriced. I think if you're buying Baidu, you're ridiculous. So the goal is to pay the least amount of money for the most amount of value. And if I were late wandering through a neighborhood buying homes and real estate, you're walking down a neighborhood where all the homes are going for like $150,000 or just that, and I'm wandering down the neighborhood trying to offer $10,000 for each. That's kind of my investing strategy, and I get takers, and I know that in the future I'll be able to sell them for more, unless they're like infested or on fire, because it's just ridiculous. Especially some of the deals that I've seen lately. So then, these are just some extra catalysts. If you wait for a market crash and then you go hunting, it gets even better. I remember Buffett used to joke about companies that were buying with price to earnings ratios less than 1. I'm looking at a couple right now that meet that criteria. Like triple-digit growth rates, single-digit price to earnings ratios. So you have growth, XXX%, and your PE is X. And if you can find situations like that, the upside is 1,000% plus. And I realize arbitrage isn't it isn't what you'd call this, but I like to think sometimes that I'm arbitraging time. So basically, I'm buying into situations where I'm very confident that I won't lose money, and then I just wait. And I wait a little bit more, and things have been working out really well. And then you just wait. And sometimes things can go against you in the short term, but I'm in for the long term. All right, and you can do it being a perma-bull, which is, there's another misnomer that there's bulls and bears in the market. And I don't know, that there's a lot of stuff that I don't understand there too. But the perma-bull strategy is to use this mental framework, and kind of like on a daily basis, these firms they'll all juggle, and sometimes you'll have them sold down 50%. So like you have a company here that you wouldn't have bought, but since it was sold down 50%, now it meets your buy criteria because you're paying half as much for the same company. And that's really the goal, to pay as little as possible. So you get a lot of juggling, and by being a perma-bull, if you're only trying to buy the best companies and they're shaking around a little bit, you buy the best companies at the best prices, and that's the goal. Another thing I like to point out, I've said this when I visited Redshift, but real investment risk, if you're buying the same thing, goes down when the price goes down, but perceived risk goes up. So like basically when the market's crashing, and this is interesting because when I visited the Chicago Board of Exchange and the option market there, the cost of insuring your portfolio, which is measured by the VIX, in times of market crisis goes up. So, does it make sense for the cost to insure your home to go up when your home price goes down? I think it should cost less to insure your home when your home price is less expensive. But in the market, it costs more to insure your portfolio when the market was, like S&P 666? Than it does today. So, the market, or assuming that the market is rational is that's a bad assumption. All right, so sure, why not? Let's chase growth. I try to only buy into situations where, I'm shocked with how cheap it is. Like, holy crap, this is cheap. And when their prices are shrinking and they're fundamentally growing, that's the goal. So the best defense in this perma-bull strategy is a good offense. You just keep going through as many companies on a daily basis. It's kind of like, wandering up and down a beach and picking up shells and looking at them all and evaluating them. Until you've looked at a large majority, you're not really sure what you're looking for. And, if you're truly, that's a stupid sentence. So people will lie to you, expect it, anticipate it. One of the things I have learned in MBA school is ways that it happens. We had a couple visitors, I think it was from MCI, or there was some crash, or I don't know, but people will lie to you, expect it, and that's another reason why you diversify. People will use you if you let them. I've been asked to help start